Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, April 18th at 3 p.m. in New York. So let's get after it. Last week, we discussed how stocks were sending different messages about growth than bonds. We laid out our case for why stocks are likely to be the most trusted on this messaging and reiterated our preference for late-cycle defensives that we've held since November. This week, we lay out the case for why this earnings season may finally bring the downward revisions to forward earnings forecasts that have remained elusive thus far. While we appreciate how inflation can be good for nominal GDP and therefore revenue growth, we think the inflation we are experiencing now is no longer a net positive for earnings growth for several reasons. First, there's the latent impact of inflation on costs that are now showing up in margins. Secondarily, the spike in energy and food costs, which serve as a tax on the consumer that is already struggling with high prices. In other words, we think the positive effects of inflation on earnings growth have reached their peak and are now more likely to be a headwind to growth, particularly as inflation forces the Fed to be increasingly bearish, which leads to another headwind, significantly higher long-term interest rates. More specifically, the average 30-year fixed mortgage rate is now above 5%, which is more than 60% higher since the start of the year, and why mortgage applications are also down more than 60% from their peak last year. This hasn't gone unnoticed by the market, by the way, which has punished housing-related stocks to the tune of 40% or more. Given the long-tailed effect that housing has on the economy, we think this is a major headwind to economic and earnings growth more broadly. Perhaps this explains why the derating has been so severe in the economically sensitive areas of the market, while defensive areas have actually seen valuations expand. This suggests the market is worrying about higher rates and slower growth, even as the overall index remains expensive. This is also very much in line with our view for defensives to dominate in this late-cycle environment. However, the overall index remains a bit of a mystery, with the price-earnings multiple down only 11% in the face of much higher interest rates. We chalk this up to the incredibly strong flows into equities from asset owners, which include retail, pension funds, and endowments. These investors seem to have made a decision to abandon bonds in favor of stocks, which are a much better inflation hedge. These flows are keeping the main index more expensive, thereby leaving the real message about growth at the sector level. As already suggested, we think that message is crystal clear and in line with our own view that growth is slowing and likely more than most are forecasting, especially for 2023 when the risk of a recession is increased. With regard to that view, signs are emerging that first quarter earnings season may disappoint, particularly from a guidance and forward earnings standpoint. More specifically, earnings revisions breadth for the S&P 500 has resumed its downward trend over the past 2 weeks and is once again approaching negative territory. This is largely being driven by declining revisions in cyclical industries where we've been more negative. These include consumer discretionary, industrials, tech hardware, and semiconductors. Negative revisions are often an indication that forward earnings estimates are going to flatten out or even fall. When forward earnings fall, it's usually not good for stocks and may even break the pattern of strong inflows to equities as investors rethink their decision to use stocks at this point as a good hedge against inflation. Bottom line, stick with more defensively oriented sectors and stocks as earnings visibility is challenged for the average company. Secondarily, wait for at least 1 or 2 rounds of earnings cuts at the S&P level before adding to broader equity risk. Thanks for listening. If you enjoy Thoughts on the Market, please take a moment to rate and review us on the Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.